Hello, MBA 503 students. This is Professor Hazara again, and this lecture is goes with the inventory lecture because Module 6 of the course, that chapter has at the beginning inventory, and I put up that just recently. I put up that video, and now I'm putting up a video on fixed assets. This one, I always say this, but this one should be faster than the others. But it's something you've seen, a lot of the stuff you've seen already, except maybe the depreciation methods and the rationale for choosing the depreciation methods. Okay, so I'm going to get right into it. And this is at this is the last topic in chapter 6, in module 6. In module 6, they have inventory, I think accounts payable, and fixed assets. I'm going to ignore the accounts payable because they're pretty obvious. But we're going to deal with inventory and fixed assets. I'll explain that in the email. Okay, let's get started. I have go ahead and minimize myself here again. I have 4 worksheets in this workbook. The first one is called Purchases of Fixed Assets. Then we're going to get into 2 different types of depreciation: straight line, accelerated depreciation, and selling a fixed asset. You've actually seen the journal entry for selling a fixed asset. Okay, now these worksheets are going to be relatively simple, so I'm going to go ahead and actually make them as I talk. There's no pre-made worksheet here, but once this is finished, I'll send you a copy of this very worksheet, like I've been doing, and I will do. Okay, now purchases of fixed assets. Now everybody knows. I think we've already gone over how to buy any asset. The journal entries, you debit the asset and credit cash, so that should be no problem. But there's a special rule regarding the cost of fixed assets. And here is the basic rule regarding the cost of fixed assets. So I'll just write here, basic rule for fixed assets. And this is very important because the amount of depreciation that you record on fixed assets under this basic rule is going to be affected. Or this basic rule affects the amount of depreciation. Okay, so here's the basic rule. The depreciable cost of an asset includes all the costs to get the asset to your place of business and up and running. Okay, so what we're saying here is that when you buy an asset, it not only includes the basic cost of the asset, it also includes any costs that it would take to get the asset to your place of business and up and running. And as examples, let me just give you examples. Costs would include, these are just examples. These are just examples, but costs would include obviously the price of the asset. That's an obvious cost. Any delivery fees, because you have to get it to your place of business, so it would include delivery fees. These are just examples. It would include installation, any costs regarded to installation of the asset in your factory. It would also include any sales taxes on the asset. Now, these are just examples, and I'm saying you pay for it, you get it delivered, you get it installed, and obviously you have to pay taxes. But I'm going to put etc. here because there's probably things in these costs that I haven't considered. But this is just a logical process of paying for it, having it delivered, installed, and you pay the taxes. Okay, but any charge to get the asset to your place of business and up and running is included in the cost of an asset. Okay, and this is very important because the cost of an asset is going to be what you depreciate, and the higher cost, the higher the cost of the asset, the more depreciation you're going to record over its useful life. Okay, so let's just go over an example of this. So we'll go down here. I'm going to put example. And I'll just go down here because I'll just do just the example here because it's not being blocked. It's by itself. Let's just say that the ABC company buys a machine. Buys a machine. The ABC company buys a machine. The company pays the following charges. Okay, so let's just say that the company would pay the following charges, and they're basically the same thing I just told you, but let's say they pay the price of the asset. So let's say the price of the asset, let's say the price of the asset is $20,000. Okay, and let's say also that they pay installation on the asset. Let's say they pay $1,000 for the installation. And let's say they pay sales taxes to the state government. And let's say that the sales taxes are $500. Okay, so the depreciable cost. So I'm going to put here total depreciable cost of the asset is just the sum of all these things. So the depreciable cost would be sum $21,500. That would be your depreciable cost. Now, like I've been repeating and repeating, is the important aspect of including such things as installation and sales taxes is that they will now be depreciated along with the price of the asset. So all these become part of the cost of the asset. They're capitalized. When we say use the word capitalized, that means they become part of the cost of an asset that is subsequently written off over many years. Okay, so let's start. Let's just finish this little example with a journal entry. So I'm going to say the following journal entry would be made. And you already know this journal entry, so that's what I'm saying. This should be a fairly easy topic. The asset would be, let's say the asset's a machine. Well, the asset is a machine. So you would debit machine and credit cash. I'm assuming everything is for cash here. So we would credit cash, debit machine, and credit cash for the total amount of the asset. But keep in mind that this 21.5 includes both the installation and sales taxes. So that means that rather than just depreciating $20,000 over the remaining life of the asset, over the useful life of the asset, you're going to depreciate 21.5. So by adding these costs into these charges for installation and taxes into the total cost of the asset, you're going to be depreciating more over the useful life of the asset. Okay, now we get to depreciation. And we're going to cover two types of depreciation. And these are basically the ones that are covered in the textbook. Okay, and they're fairly straightforward. We've already kind of seen them in a sense, but we go over them in a little more detail here. Okay, and the first type of depreciation is called straight-line depreciation. Now, straight-line depreciation, the major characteristic of straight-line depreciation is straight-line depreciation. And by the way, we usually refer to straight-line depreciation. I'll put the acronym in here, SL. When you see SL depreciation, it means straight-line depreciation. So anyway, SL depreciation, straight-line depreciation, records the same amount of depreciation expense per year. Okay, so that's the general aspect of straight-line depreciation, is that every year you record the same amount of depreciation. And so it's not a very complex thing. We've already done it in a couple of examples we did back in January. It seems like an eternity ago, but a couple of examples we did back in January for straight-line depreciation. And we're just going to get a little bit more into detail here. Okay, the first thing is there's a formula for straight line depreciation, and the formula for annual the formula for annual straight line depreciation expense is, and be careful with this one, okay, and I'll just write this out. It is the asset cost minus the asset's salvage value, and we'll talk about salvage value in a second. Okay, and that's all divided by the average cost minus the asset's salvage value, come over here, divided by the useful life. Useful life, and that's in years. The useful life is in years of the asset. So when we take the asset cost, the cost of the asset, which includes those extra charges, by the way, and subtract out the salvage value, and the salvage value is just basically your trade-in value. So if you had a car and you used it for 5 years, whatever the trade-in value is, whatever you could get for it at the end, that would be your salvage value. It's called salvage value because most of these assets are junked. But anyway, basically it's what you can get for the asset after it's no longer operational. Okay, so the asset cost, you have to take out the salvage value and you divide by useful life, and that will give you your annual depreciation expense. So what you need to do to calculate the annual depreciation expense is use this formula right here. Okay, so now let's do an example. I'll try to put it all in the worksheet and we'll see how this works. Okay, so in this example, let's just say it's going to be based kind of on the using the previous data. Let's say I'll just put here's an example. This is not a terribly hard example. Let's say that the cost of your asset is $21,500, and think of it as the price that I just calculated right there. Assume that it includes installation and sales taxes. Okay, and so you decided to depreciate this asset on a straight line basis, and so the cost is $20,000 plus the $1,500 extra charges, $21,500. Okay, let's say that the salvage value of the asset, so the salvage value of the asset, let's just assume it's $2,000 is its salvage value. And let's say that the useful life of the asset, so we have useful life of the asset. Let's say the useful life of the asset is 5, and let's be specific, 5 years. Okay, so these two first numbers are monetary amounts, the cost of the asset and what you can get, the dollars you can get for it at the end of the asset's life. Okay, and the useful life is in years. Okay, so let's go ahead and change this here a little bit. Let's say that, let's make sure to specify that these are dollars. So these are dollars right here. So both the cost, oh, didn't do it right. I'll put the currency amount in there. Okay, so the cost is $21,500. The salvage value is $2,000, and the useful life is 5 years. So we're talking about different units here. The cost is dollars, salvage value is dollars, and the useful life is dollars. Now let's plug in. I'll go ahead and kind of stretch these out here, but let's plug these numbers here into this formula here. Okay, so we're going to see that the numerator of the formula is the cost of the asset minus the asset salvage value. Okay, and I got to open the parentheses. So that's 19,500. And if you just look at that, that's the formula right there. You take the cost less the salvage value. Okay, and the useful life of the asset is 5 years. So let's go 5 years there. Okay, and so by taking 19,500 and dividing it by 5 years, what you're going to get is, we're going to do that now, 19,000 divided by 5. Okay, and you can see the formula right there, 19,000 divided by 5. What that's going to give you is 3,900, and I'm just going to say that is going to be your annual depreciation. And in this example, that depreciation will not change. You will record every year of this example $3,900 in depreciation. Now, this means that you assume that the asset will be equally productive over each of those 5 years, which is not generally the case, but straight line depreciation is used for simplicity in many cases. It's used, assets are generally, companies usually take groups of assets, put them into one big group, classify them, and depreciate the whole group. But straight line depreciation is a benchmark depreciation method. So that's where that's why we're using it here. Okay, now what I'm going to do is extend the example out to these columns over here, all these columns over here. And what I'm going to do is I'm going to show you the journal entries that you're going to have to do that you would do in straight line depreciation. And then I'm going to show you how this would look on a balance sheet. I'm not going to do T accounts in this case, but because I think you should already know that. These are just two accounts here, the asset and the accumulated depreciation. The depreciation expense, as you should know by now, is closed to income. So that becomes 0 at the end of each year anyway. But the two balance sheet accounts we're going to be working with aren't closed, and they are the asset account, property, plant, equipment, call it what you want, and the accumulated depreciation. Okay, so we've got here 5 years that we've got to account for. That's the useful life of the asset is 5 years. So in these columns over here, what I'm going to do is just label these columns. The first one I'm going to label is period. There's 5 years. I'm actually going to have 6 points in time over those 5 years. So we're going to start with the period. Okay, and then I'm going to put the journal entries. So I'm going to have accounts, and then I'm going to have debit, DR. You should know that DR means debit now. And I'm going to have credit right here. And then over here, I'm going to have how the balance sheet would look. Actually, I'm going to put that right here. See if I can save some space here. I'm going to put how the balance sheet would look over in column K over here for each of those entries. Okay, so let's start with period 0. I'll do the first 3 periods, and then you'll see where I'm going. I'm going to do the whole thing, but also, if you understand the first 2 or 3 periods, that's fine. Start with period 0, and you might be thinking, why is he having period 0 when there's 5 years? Because period 0 is to purchase the asset. So I'm going to start with period 0. That's when you buy the asset. Then I'm going to come down maybe 4 here and put period 1. This is the end of year 1. And this would be, let's say this is the end of year 2. Then you have the end of year 3, the end of year 4, and the end of year 5. Okay, so let's do the entries, and they're going to be incredibly repetitive. Okay, so the first thing you have to do is buy the asset. So let's say you bought, let's call it a machine. So let's say you have an account called machine. So you're going to debit machine and credit cash. Okay, and that's going to be for the full cost of the asset. Big rule here is you always need to debit your asset account for its full cost, including all those charges like taxes, installation charges. You have to debit your machine, your asset account, for the full depreciable cost. So just to reemphasize, these two numbers, the cost of the asset and that debit, must always be equal to each other. Okay, and of course you would credit cash. Okay, now let's go over to the balance sheet. And here's how what your balance sheet would look like is you would have in the asset section, this is in the long-term asset section of your balance sheet, you're going to have a machine. You're going to have an account called machine. I'm not going to put up the T accounts like I did for accounts receivable. This is a little easier, I think. And then you're going to have minus accumulated depreciation against that machine. And now, if you take the machine less the accumulated depreciation, we call that net book value. That's a term we use. And sometimes we use the acronym NBV. That stands for the net book value, which is your book value less the accumulated depreciation, your net book value. Anyway, so at time period 0, I want you to notice something. You'll notice that at time period 0, we have a debit. This is a debit to the machine account for $21,500. Notice that accumulated depreciation is 0. There's no entry here. There's no entry in this first journal entry. There's no impact on accumulated depreciation. There's only that debit right there, which is, let's make sure we got that. Notice that that debit is equal to that debit right there. So your machine account is equal to $21,500. There's no accumulated depreciation. So at the end of the asset's useful life, or what am I saying? Right after you purchase the asset, at the beginning of its useful life, the net book value is equal to the cost of the asset. So I'll outline that right there. The machine less 0 in accumulated depreciation gives you a net book value of $21,500. Okay, now I'm going to go ahead and start depreciating the asset. And since depreciation is the same for each one of these years, what I'm going to do is I'm just going to go ahead and I'm going to just repeat the same entry, just basically copy the entry down in a sense. Okay, so at the end of year 1, this is end of year. So this is all end of year. Everything here is end of year. These are end of year adjusting entries. You cannot record depreciation unless time has gone by. Okay, so every year, here's what we're going to do. We're going to debit depreciation expense and credit accumulated depreciation. Okay, now I'm just going to go ahead and copy those accounts down because those are going to be the same accounts every year. So I'm just going to go ahead and copy these accounts down every year. Okay, so we're going to make, every year we're going to make this entry. Okay, and so how much is the entry going to be for? Well, we already know. The entry is going to be for, every year, it's going to be for $3,900. So Straightline is very easy. Once you compute the $3,900 out of this formula over here, then the depreciation entry is repeated every year. You could probably have a computer do this if life were that simple. Anyway, so it's just it's a year-end adjusting entry. It's a year-end adjusting entry at the end of every year for 5 years. Okay, so let's see what the balance sheet would look like at the end of year 1. So I'll just go ahead and copy these account names down here. Okay, now at the end of year 1, notice here's a major rule. your machine account is still 21,500. And so I just said it's equal to 21,500. And how can I say that the machine account hasn't changed? Because if you look at the first two entries, if you look at these first two entries, there's only one entry to the machine account. It's right there. I don't know if that's showing up. Sometimes the cursor doesn't show up. But the machine account is only impacted once in that debit right there. After the machine account, after you debit the machine account, when you buy the equipment, you don't make any other entries to the machine account until it's sold, until and if it is sold. The account that does change is going to be accumulated depreciation. And accumulated depreciation is going to be equal to last year's accumulated depreciation, which in this case was 0, plus the credit to accumulated depreciation this year. So your new accumulated depreciation is $3,900. So I'll just go back and make sure to show you that formula right there. Your new accumulated depreciation is $3,900, and your net book value is now going down because your asset has stayed the same. However, your accumulated depreciation has gone up. So your new net book value is $7,600, and it is $21,500 minus $3,900 right there. Okay, so what I'm going to do, I'm going to make sure, to mark these. You can see that the machine was a debit. You can see that debit to machine resulted in that $21,500, which it stays on the books until the machine is sold. You can see that the accumulated depreciation right there is a credit. But I'm just going to go ahead and keep emphasizing that you've got a debit balance for machine, you've got a credit balance for accumulated depreciation, and you've got a net debit balance, which is your net book value. Okay, so now we come down here again, and we will go ahead once again and make our depreciation entry, 39,500. What am I saying? 3,900, and of course the credit will equal that. Okay, so we've got $3,900 in depreciation. Now that's an entry that's made at the end of year 2, an end of year 2 adjusting entry. Let's take a look at the balance sheet again. You can guess what's going to happen here, I would believe. Okay, so our balance sheet will have machine less accumulated depreciation gives you your net book value. Once again, there's no entry. The only entry I've made to machine is right there. There is no entry in at the end of year 1 or the end of year 2 to the machine account. So, like I've been saying, the machine account stays the same, $21,500. Okay, now your accumulated depreciation, and this gets very repetitive, is going to be the previous year's accumulated depreciation plus the depreciation expense that was added for this year. So your accumulated depreciation is last year's depreciation expense, or accumulated depreciation of $3,900 plus this year's depreciation expense of $3,900. So your new accumulated depreciation is $7,800. Okay, and your new net book value is $21,500 minus $7,800. Your new net book value is just the net of those two numbers. Your machine never changes, $21,500, but your accumulated depreciation increases, so your net book value goes down from $21,500 to $17,600 to $13,700. And the pattern is going to repeat itself. We'll do the same thing for 3 more years. I should have just used a 3-year example, but we'll do the same thing for 3 more years because there is an important rule at the end. There's a very important rule at the end of year 5. Okay, so we know that we'll be depreciating. Actually, I want to do this. I'll make this equal to that number right there. I'll make that number right there. And we'll go ahead and update our balance sheet, our new balance sheet at the end of year 3. Machine will be equal to $21,500. The new accumulated depreciation is going to be $7,800 plus $3,900, which is your depreciation. So if we put it right there, there's your $7,800 plus $3,900. And your new net book value will once again be $3,900 lower than the previous year's net book value. So it's going to be 21,500 minus the 11,700. That's going to give you 9,800. And it's those two, the net of those two amounts right there. Now I'm going to finish the last 2 years. And I do want to point out that something that's very important at the end of year 5. Okay, so one more year to repeat, 2 more years to repeat, and we'll do this fairly quickly. We'll put a line right there. Okay, and once again, I'll just go ahead and do these entries at once. Or we'll do these entries like this, and that's equal to that. The balance sheet is just going to be extended down. So there's your account balances right there. This is equal to 21,500. This is the new accumulated depreciation is going to be equal to 11,700 plus the new depreciation expense of 15,600. So your new net book value is 21,500 minus 15,600. So your new net book value is 5,900. That is a net. I'll go ahead and just show the equations again. That's your new accumulated depreciation, 11,700 plus 3,900, and your new net book value is 5,900, which is just the net of those two items right there. Okay, then finally we'll do our last year's depreciation expense, and to be pure about it, I'll go back up to here. There's your depreciation expense. The accumulated depreciation is the same. Okay, so we are going to bring the balance sheet accounts down. Okay, and once again, the machine doesn't change. You could look at this for any one of these things, and the machine simply doesn't change. It's equal to the last year's machine because there's been no entries. None of these entries here, if you look at it, we've had one debit to machine, and everything else is debit depreciation expense, credit accumulated depreciation. So the machine stays as a debit of 21,500. Your new accumulated depreciation is going to be last year's accumulated depreciation plus this year's new accumulated depreciation. So our new accumulated depreciation is 19,500. And I want to point this out, and this is why I wanted to go all the way down to the 5th year, but your new net book value is equal to 21,500 minus 19,500, or $2,000. It is not by coincidence. As a rule, when you finish using up a machine or any depreciable asset, the final net book value must be equal to the salvage value. So that 2,000 right there, the salvage value, is equal to the final net book value. And I'm going to put this, and I'm going to say the final NBV, net book value, is always equal to the salvage value. So we'll just say that right there. Okay, and that almost finishes my little lecture on straight line depreciation, but I just want to make sure that we put these debits and credits in the right place. So the machine is always going to be a debit, and it's not touched until you sell a machine. The accumulated depreciation is a credit, and then the net book value is always a debit, assuming that you've done your estimates of the machine's life are good, and we're assuming that here. Okay, so I'm just going to go ahead and make sure to copy. These are just reminders that all these things right here are always just to remind you of the debits and credits. And I run out of room here, but you know that that's a debit. That's a debit. The accumulated depreciation is a credit. And finally, the net book value here is going to be a debit too. The net book value is always equal to the salvage value. Okay, so the main thing about straight line depreciation is the depreciation is the same every year. That's the basic rule on straight line depreciation. Now let's go over to accelerated depreciation. which is generally a little more involved. But, okay, let's go to the blank worksheet here. Accelerated depreciation. Accelerated depreciation, what you do is literally you accelerate your depreciation. You depreciate more in the early years of an asset's life than you would during the later years. So, and you're going to see that you might depreciate half of the depreciation in the first year, and 25% in the second year. It depends on how you set the thing up, but the major aspect of accelerated depreciation is that more depreciation is recorded early than later. And that actually, most people would argue that accelerated depreciation is more realistic. Think of a car. You know, everybody always says that the cars accelerate more in the first 1 year and maybe 1 or 2 years than they do in the later years, and that's true. You drive it off the lot, it starts depreciating very rapidly, and then maybe you fix it up a little bit and you can keep it running for 10 years. But basically, the useful life in a original car it's really concentrated in the first 1 or 2 years before the thing starts having mechanical problems, et cetera, et cetera. Of course, that also depends on the car you buy. Okay, like in the book, I'm going to emphasize there's different methods of accelerated depreciation, but the major one is called declining balance depreciation. Okay, and basically it's just saying that you have a declining net book value during depreciation. It's not, I mean, that's true for straight line, but this is just saying that the balance is just really going down fast of the net book value because you're recording so much depreciation early. Okay, and there's a couple of preliminary steps in declining balance depreciation. First, the first step, we're going to say first, compute the straight line rate of depreciation. So first, we're going to go ahead and compute the straight line rate of depreciation. Okay, and here is the equation for the straight line rate of depreciation. Okay, and I'll even put sort of, first compute the straight line rate of depreciation, which is equal to the following. The number 1, it's a ratio, divided by the useful life, the life of the asset. Okay, so using the numbers that we've been using, the numerator is 1, no problem. And we know that the life of the asset, we know that the life of our asset, we're using the same numbers here, is 5 years. So our accelerated depreciation, our straight line depreciation rate for this particular asset is 1 divided by 5, this. So our straight line rate is equal to 1 divided by 5, or 20%. Now, that's obviously, you're computing the same depreciation over 5 years, it's 20%. So that's our first step in declining balance depreciation. Okay, and our second step is I'm going to say second, so I'll do this. Second, compute declining balance rate. And to save myself space, I'm going to go ahead and wrap this text, hopefully. Okay, so our declining balance rate is equal to the following. Our declining balance rate, I'm just going to say, is equal to a declining balance percentage. Now, I need to emphasize that this percentage, and I'll try to say this down here, it's arbitrary. This percentage, which is your declining balance percentage, it's an arbitrary number that you choose, usually between 1, which is 100%, and 2, which is 200%. Or it could even go higher. But this rate determines how fast you will depreciate your asset. If you think you should depreciate your assets really fast, give this a high rate. If you think that they will depreciate at an accelerated pace, more than straight line, but not much more, then you might use a low rate. So if you use 1 here, you'll get your straight line rate. So it's got to be greater than 1. Okay, you'll see here. Okay, so we're going to take our straight line, our declining balance percentage. I'm going to put, and we're going to multiply that times our straight line rate. Okay, so here's how we're going to do this. We're going to use double declining balance. So we will use what is called double declining balance. And people always get this confused, but double declining balance is just declining balance depreciation using a declining balance percentage of 2. What we're just saying by using double declining balance, it's just you're going to double your straight line rate. We could use 1.5 here. We could use 1.1. We could use 3, but we'll use 2, and that's why it's called double declining balance. But I want to make sure that you understand that you can choose your rate here. If you think that your depreciation should be double the straight line rate, use 2. If you think it should be 1.5 times, use 1.5. But all double declining balance it's declining balance with the rate of 2 here. Okay, then we're going to multiply that times our straight line rate, which is 0.2. So we know that's 0.2. Okay, and so our declining balance rate is going to be twice the straight line rate, twice the straight line rate. So our declining balance rate there is going to be our arbitrary percentage times our straight line rate, which is 20%. So our declining balance percentage is going to be 40%. And we're going to use that 40%. We're going to apply it to the net book value every year. And you can see if we double the straight line rate, we're going to get really an acceleration in the early years of our depreciation expense. Okay, so what I'm going to do here is I'm going to go down here. I'm going to get off this screen a little bit. Now we've got our declining balance rate, and I'm going to set up a little table, and that table is going to give me the amount of depreciation expense for each year. Okay, so let's go ahead and we'll set up. It's going to have, I believe, 4 columns. Okay, this is the time period. Remember, we've got 5 years here. Okay, so that's the period. This is, I'm going to say net book value. And I really should say this is your beginning net book value. That's your net book value at the beginning of the period we're talking about. Then we're going to just put our rate, which is our declining balance rate. That's going to be a very easy column. They're going to be the same up and down. Okay, then we're going to compute our depreciation expense. And then we're going to put remaining net book value. Okay, and the remaining net book value is basically your ending net book value. Okay, so here we've got 5 periods. 1, 2, 3, 4, 5. And period 5, once again, we're going to have that salvage value issue. It's going to be a little trickier here, but than the straight line, but we can take care of that. Okay, now let's get our rate down. Our rate is going to be equal to 40%, and that doesn't change. So I'll just go ahead and copy this down. So our rate is equal to 40%, obviously frozen. Okay, so our rate is going to be equal, our declining balance rate is equal to 40%. And let's just start making this table. It's not too hard. Our beginning net book value it's really our beginning net book value. I'm just going to write it in here. But our beginning net book value is 21.5. We're using the same numbers. And your net book value right after buying this piece of equipment is 21,500. So we're using the same numbers. So I'm just going to type 21.5. I usually like to link things, but I'll just go ahead. That's 21,500 is our beginning net book value. Okay, so if you take your beginning net book value for that year, at year one it's 21.5, and multiply it times your depreciation rate, that will give you your depreciation expense for that particular year. So for year one, we're going to have depreciation expense of 8,600. Okay, and the remaining net book value, so I'll go ahead and just highlight those. Say your depreciation expense is net book value times the rate, and our remaining depreciation expense, or what am I saying? Our remaining net book value is just the beginning net book value minus your depreciation expense for the year. So your remaining net book value is 12,900. Now look how fast we're depreciating here, and we're going to look at the entries in the balance sheet in a second. But your remaining net book value for under accelerated after the first year is 12,009. You go back to straight line, your end of year one net book value is 17,600. So that's a pretty heavy acceleration of depreciation. Okay, now what you do is once you have your first line, you can copy. It's a perfect problem for Excel for just copying down. First thing you have to do is you bring down last year's, the ending net book value for period one becomes the beginning net book value for period two. Okay, and then your depreciation expense, so I'll just go ahead and highlight that. That comes down there. And then your depreciation expense for year two is just your beginning net book value times your rate, 40%. So for year two, your depreciation expense is 5160. Okay, and then your remaining net book value, and I'm just going to go ahead and highlight that. So it's just your beginning net book value times your rate. And your remaining net book value is once again your beginning net book value less this year's depreciation expense. So your remaining net book value, oops, take that negative out of there. Your remaining net book value is 7,740. And if you compare that to your second year net book value for straight line, this is really accelerated depreciation. Your net book value for accelerated depreciation is sinking really fast. So it goes down a lot faster. Okay, and this would be for assets which you believe will produce a lot more in their earlier years. Okay, so now we can finish this table, I believe, just by copying down to here. And yes, that works. Okay, and I'm going to go ahead and put these in dollars just to make sure that we're labeling everything correct. So we'll put everything, all the dollars, in dollars. Okay, do this. There's that right there. And then we have we'll format these as dollars here. Okay, so that's our table. And, you know, you have 5 periods there. And let's just review your depreciation, your net book value is always brought down. That holds true for all these years. I'm using year 3 here. Your depreciation expense is always your beginning net book value multiplied by your depreciation rate. and your remaining net book value is always the beginning net book value less your depreciation expense. And that will hold true for any one of these years. Okay, now to finish this part of the lecture, what we're going to do is I'm going to go ahead and make the journal entries again. Okay, so just like I did for Straightline, I'm going to go ahead and make the journal entries. The year 5 entry is going to be very important because notice that the rule was that ending net book value has to be equal to the salary value, which is $2,000 in this example, and it's below that. So we're going to have to make a slight adjustment to year 5. Anyway, let's go ahead and make the entries and the balance sheet. Okay, let's see. We're going to have period. So we'll have period here. We'll have account. We will have debit, credit. That's the journal entry. And finally, we'll put the balance sheet over here. Okay, so let's start with period 0. Then we'll do skip 4 down and do period 1, period 2, period 3, period 4, and period 5. And it shouldn't be. I know I'm going off the sheet here a little bit. I'll shrink it a little bit here, but I don't think it'll make much difference. And once you see the first 3, 1 to 3, you'll see a lot of repetition here. Okay, so first, like as we did in Straightline, we have to buy the asset. So we're going to debit machine and credit cash. Okay, and we know that you always have to debit the machine for its original cost, which was $21,500 throughout these examples. Okay, on the balance sheet, we're going to have asset, whatever the asset is, machine, whatever it is, minus accumulated depreciation is going to give us our net book value at the end of the year. Okay, so after the purchase, just like we did for our Straightline, our machine is $21,500, our initial accumulated depreciation is 0, and our net book value is the difference between the two, which is $21,500 minus 0, which gives you $21,500. So our asset, I just want to make sure, our asset, make sure to realize that our asset is always equal to the entry, the debit to the machine account, to the asset account, whatever that is, and that the debit to the machine account should always equal your initial net book value. Very important rules. Okay, now for each year, we're going to make the same account entries. We're going to, as we did for Straightline, we're going to debit depreciation, expense, and credit accumulated depreciation. So, and I'm just going to go ahead and copy that down because we're going to do that 5 times. So we'll go ahead, let's just go ahead and copy these down. Excuse me. We'll go ahead and copy these down to each one of these years, especially in this case, because the numbers here are more important than the accounts. Okay, and we know our depreciation expense from this table over here. Our depreciation expense for year 1 is going to be equal to $8,600. Okay, and let's go ahead and take a look at the balance sheet. Just exactly as it was for Straightline, your asset amount doesn't change. Your accumulated depreciation, like for Straightline, is going to be equal to the beginning accumulated depreciation plus your new depreciation expense, or $8,600, and your net book value is going to be equal to the asset less your new accumulated depreciation, or $12,009. Couple of things, let me go over these. The asset doesn't change. That will always be the case. Your accumulated depreciation is equal to last year's accumulated depreciation plus this year's depreciation expense. And your net book value is equal to the difference between your asset, which doesn't change, and your accumulated depreciation. I do want to point out, I can't really do this using an equation, but I want to point out that the net book value on this table is going to be equal to the net book value on your balance sheet. And obviously, these be reflected in the T accounts, but I think you can understand without the T accounts. Okay, so let's go to our next year. Our next year's depreciation expense is $5,160. And once again, we have balance sheet. Once again, the asset account will be, what happened there? The simplest thing. Oh, I'll just stretch it out. I'll format all this at the end. Okay, so your asset account is 21,500, which is equal to that number right there. Your accumulated depreciation, once again, is going to be equal to your beginning accumulated depreciation plus your depreciation expense. So there's that number again. And your net book value is going to be equal to your asset account minus your accumulated depreciation, which is 7,740. And I want to point out again that that 7,740 is equal to that 7,740. The net book value on the balance sheet will always be equal to the net book value for whatever year it is on the table. Okay, let's finish this up, and we'll do a couple of quick transactions and selling an asset. Okay, so your accelerated depreciation, your depreciation for year 3 is 3096. So we've got, this is going to be 3096. Your balance sheet is going to be the same. It's going to be 21.5. Your accumulated depreciation is going to be your beginning accumulated depreciation plus your new depreciation expense. That's summing up very quickly. And your asset account, your net book value is going to be your asset account minus your new accumulated depreciation. So you get a new net book value of 4644, which is equal to that book value right there. That's a good way of checking it, by the way. Okay, and so just to go over this once again, that doesn't change. Accumulated depreciation, just your beginning accumulated depreciation plus your new depreciation expense, and your net book value is just the difference between the asset and the accumulated depreciation. Okay, then we come down here to our 4th and 5th years. For our 4th year, our depreciation expense is $1,858. Excuse me. Is your new depreciation expense. Your asset, your balance sheet is going to have the same accounts in it. So your balance sheet is going to have, your asset account is going to be 21.5. Your accumulated depreciation, as usual, is going to be your beginning accumulated depreciation plus your depreciation expense, and your net book value is going to be the asset less your accumulated depreciation. I'm just going to go up here and put lines under these numbers to emphasize that net book value is a subtotal. And then we come to the last year. Now, according to our table here, our last year's depreciation expense should be $1,115. The only problem is if you took the net book value of 2,786 and depreciated $1,115, your final net book value would go below the salvage value. So the only thing that we can do here is depreciate for 786. And that 786, I'll put it right here, that 786 is 2786, what am I saying? 2786 minus the $2,000 salvage value. And I'll go ahead and put an arrow there. That's the 786 right there. And what I'm doing is saying we have 2786 left. If we went by our table, we would depreciate 1,115. We would go below salvage value. So the only amount that we are allowed to depreciate, given the rule that your final net book value has to equal your salvage value, the only amount we can depreciate is 786. Okay, so our last year's depreciation is 786. Okay, and let's say that we'll take a look at the balance sheet again. Take a look at the balance sheet. The balance sheet is now going to be, the asset account is always the same. The accumulated depreciation is going to be last year's accumulated depreciation plus this year's depreciation expense, which gives us 19.5, and you can see we're going to get the correct final net book value. Okay, and so 21,005 minus 19.5 gives you, I don't know what's giving me that cents. It's probably got rounding embedded in it. Let's go ahead and fix that problem right in here. Let's go ahead and just fix that. And it is currency, but with zero. Zero. So I'm just going to put final net book value equals salvage value. That must always be the case. Okay, but I'm going to put, because I'm obsessed with dollar signs, being an accountant, I'm obsessed with dollar signs. I'm going to go ahead and make sure that all those have the dollar sign in front of them. Okay, and that finishes the accelerated depreciation portion of this lecture, but make sure to abide by this rule. Whether you're using straight line or accelerated depreciation, your net book value, your final net book value, always should be equal to your salvage value. Okay, and just to repeat, your final year's accumulated depreciation is your beginning accumulated depreciation plus your new depreciation expense, and your net book value is just the difference between 21.5 and 19.5, which is the same numbers we ended up with in straight line. The big difference, we depreciated 3,900 every year in straight line. Here we depreciated. Our first 2 years were greater than straight line. Our middle year was a little bit less. And so what happens is that if you use straight line, you had 3,900 each year. When you accelerated depreciation, you recorded more than straight line in the early 2 years, and then it went down beneath straight line. So the first 2 years were over 3,900, and then these last 3 were less than straight line. Okay, let's finish this lecture up by just doing, and we've already done this in class. Actually, we did it in class with a statement of cash flows, but I might as well do this. Let's say when you sell a fixed asset, let's just go over an example. Let's use, and I'm just going to go ahead and cut and paste these numbers. Let's say we're this company right here, and we're at the end of the third year where we have an asset of 21.5, accumulated depreciation of 16,856, and net book value is 46.44. And I'm just going to go ahead and copy these as values over here. Okay, just to say, so we're at the end of, I got to copy these things as values. Okay, special here. to values. I know there's an easier way. Okay, so we're at the end of year 3. So we're at the end of year 3 for the previous example, and we've decided we may want to sell this asset. Okay, and let's just say, we've done this in class already. Let's say you can sell for a gain, or you can sell for a loss. Okay, so let's just say in the gain situation, you sell the asset. The asset has net book value of $46.44. Let's say you sell for $6,000. Your entry to record the sale of the asset would be, here would be your entry. I'm going to go out here a little bit. Your entry would be, you would debit cash, you would debit accumulated depreciation, you're going to credit, so you're going to credit, so let's go 1, 2, 3, you're going to credit the asset, the asset account. The asset's the same as machine. I'll have to, next time I do this, I'll have to say machine, whatever, but it's the asset account. And then you're going to credit 1, 2, 3, you're going to credit a gain. Okay, and it's a fairly easy entry. You're going to debit cash for $6,000. You're going to debit accumulated depreciation for, you're going to do this. You're going to debit accumulated depreciation for, that's just equals, for the total accumulated depreciation. You're going to credit the asset account. So after you made the debit to accumulated depreciation and credit to the asset account, the amounts in those accounts would be 0, assuming you didn't have anything else in there. And then the gain, I will do this correctly here. The gain is going to be basically, the gain you can compute a couple of ways, but the gain, I'm going to do it this way. It's equal to the 6,000 less the net book value of the asset, 64.66. So you have a gain of 13.56. You can also use it as a plug entry. I just want to make sure that this entry balances. So I'm going to do your cash plus your cash plus your accumulated depreciation gave me 22,856 on the debit side, and the asset plus the gain gave me 22,856 there also. You don't have to do that. I'll even take them out. But the gain is equal to, I'll just put a thing here. It's a plug entry, but officially the gain really is equal to the $6,000 cash minus the 46.44 net book value. And you should be able to see that by looking at the equation right there. Okay, so we've done that in class. Now the gain, the final thing about it is, I'm going to say gains are closed to retained earnings. Gains are like revenue. Revenue goes up with credits, so do gains. Okay, let's do the loss situation. Let's use some easy numbers. Let's say for a loss, you sell the asset for $4,000. Okay, and so you already know what your accounts are going to be. You're going to have a debit to cash. You're going to write off your accumulated depreciation. You're going to debit a loss in here, and you're going to credit the asset account. Okay, in this case, the cash you get on the transaction is $4,000. The accumulated depreciation, I want you to notice that the debit to accumulated depreciation doesn't change. The credit to the asset account doesn't change. The only thing that will change, so the cash is what you get. The debits, it doesn't matter how much you sell it for, you're still writing off the same amount, assuming different scenarios. Doesn't matter if you start for 6 or for 4,000. You're going to write off the same amount of accumulated depreciation, and you're going to write off the same amount of asset account. Now, the loss here is really going to be, the amount of loss is going to be equal to the net book value. You could do this in reverse, but the debit actually means that it's a negative adjustment to retained earnings. So going to be the loss is going to be the net book value minus that 4,000 right there. And I just want to make sure that I've got the numbers right, so I'm going to total these things up to make sure that my debits and credits equal. Okay, 21.5 and obviously 21.5, so my debits and credits do equal. I'll take that out so that people don't think they need to do that step. Okay, and the loss is equal to the 46.44 minus $4,000 cash. Okay, so it's the net book value less the cash. Okay, I'm going to say here losses are closed to retained earnings. Okay, and I'll just go ahead and point that out again. 4,000 EC5. Let's go up here. Go up here and get this here. It's those two numbers right there. 46.44 less 4,000. So they gave you 4,000 for something worth 46.44. So you lost $644. Okay. So anyway, that's the lecture. I'll be in touch. But keep in mind this chapter has two important, let's say, parts to it that we'll concentrate on: the basic aspects of inventory and the basic aspects of fixed assets and depreciation. The inventory is the first part, the fixed assets are the last part, and I think accounts payable are in the middle. We're going to cover some liabilities, but in a couple of weeks, but they're going to be long-term liabilities. Accounts payable, there's all sorts of little dinky things with it, but we'll do that. Anyway, so I hope everybody's feeling well and staying safe. I'm certainly going to be staying safe, and I hope, wish everybody the best. Anyway, so we're finished with this lecture. I will be in touch probably Sunday sometime with an email about these. I've got to upload. Anyway, happy accounting, let's say.